Let's start with China then. Your views on the economic recovery here, as David was pointing out, services in terms of that non-manufacturing PMI print for the month of June, disappointing quite significantly. Are you concerned that you're seeing less than a balanced recovery here?
Yeah, we think there is some slowdown, but that's not negative. In fact, China has been tapering its stimulus policies, and they have been trying to slow down the acceleration of credit expansion. That's not a bad thing for the markets. It kind of prolongs the expansion and the recovery. And given where equities have been trading in China of late, the softness and all that, I think it's not a bad time to, to rebuild positions in equities in China.
Okay, well, let's unpack that. Where exactly would you be focused in terms of the Chinese markets, Wey Fook?
Yeah, so the way we construct our portfolios, be it Asia-centric, be it global, is to implement what we call a barbell strategy. On one end of the portfolio, take overweight positions into income generators. Now, in the case of China, there are China banks that we like a lot. They are giving you 5 to 6% dividend yield on a sustainable basis. And then on the other side of the barbell portfolio construct, we like what we call the secular growth companies. So you've got the e-commerce, you've got the cloud computing companies, and they're all trading in the mid-20s, in terms of price to earnings. The visibility for earnings growth, double digits going forward, is quite clear in the next several years. So that's how we're going to position our portfolio in China.
Wey Fook, David here. On this Delta variant, do I need to be concerned?
Well, the Moderna has come out with, and said that the vaccine can take care of Delta. In Asia, unfortunately, some parts of Asia, ASEAN in particular, we're still very slow in terms of the vaccination, but we'll get there. I think the whole world will get there. It's just a matter of time. So, for now, we prefer the US and to some extent the European markets because the vaccinations have been a lot more faster, but we'll get there in Asia. So in Asia, we continue to like what we call companies that are, still riding the trend of the world becoming a digital economy, and that's very, very powerful, a trend here.
In fact, I wanted to build on that, a follow-up to the sort of tech plays. What we've seen, at least in Asia, Wey Fook, is whether temporary or not, it's a shift from the large caps, and you look at where the Chinex index has gone in the past few weeks or so, to the smaller names. Do you think that's a temporary shift in their thinking of how to get exposure to disruption, technology, innovation? Or do you think that's more permanent?
Yeah, I think it's, the smaller cap, the A-share market, for example, they are value plays, domestic consumption plays. But really the broad theme of, digitalization will favor big tech companies. And, we will take our cue from the US. And if you look at the US, the FANG stocks, so to speak, are already coming back. And again, for them, despite pretty high valuations, the visibility for earnings growth for the next several years is pretty clear, and we therefore think that in Asia too, we'll see that big tech companies will come in strong, the likes of, Samsung in Korea, TSMC in Taiwan, and of course, the Alibabas and Tencents of China.
Okay, let's talk about earnings in the US then. Do you expect the earnings to be able to support any removal or even a start of tapering, that a removal of support from the Fed that is expected at some point? We don't have the exact time frame, of course, but if you start to get a tapering of the balance sheet, do the earnings step in and support?
Yeah, the earnings are pretty clear in terms of the visibility as well, because of the reopenings. So the value sectors or the laggard sectors like banks and energy stocks are coming back pretty strong. Tapering will not turn the earnings trajectory. We think tapering is, again, not a bad thing, provided, it is being viewed as, the Fed as being preemptive. And I think that's not a bad thing. So if you look at 2017, when the Fed reversed the QEs, 1, 2, and 3, interest rates went up, Fed funds, bond market yields went up. did the markets or did the equity market fall? No, it continued to go up. Because inflation is not a runaway situation. Why do I say that? If you look at Japan, Japan is really the forerunner. It has been doing QE and deficit spending for the last 20 years, yet there is no inflation. Why? Because of demographics. So the aging population factor, or headwinds to inflation is going to be the same across the world. So we do not think, inflation is that much of a problem. We are basically aligned with the Fed to say that this is transitory in nature.
And just to wrap things up here, the general thesis from you is, and I'm going to read it out, that risk assets will be supported because of FOMO, fear of missing out, and TINA, there is no alternative. Is that another way of saying that fundamentals do not matter?
So the way to look at the markets is really fundamentals, valuation, and technicals. So when I talk about FOMO and TINA, they are primarily, in the technical space, the fund flow space, as well as valuation space. Equities on a standalone basis is expensive, but you have to look at it on relative terms, right? Bond yields are so low, so the yield gap is still very much in favor of equities. Now, fundamentals are not negative too. This reopening of economies, which will take place all over the world with the rollout of vaccines, is actually a tailwind. So we've got fundamentals, valuation, and technicals really very much, aligned